So the recession is here in Europe, but it's not here in the US. So that discrepancy has only grown even wider since the last time we updated you on Steno signals. The signals are telling me that oil markets could rally another 25% during the fourth quarter. Welcome to this live edition of Steno Signals, sending to you live from my hotel room in Oslo, Norway this week, visiting clients in the very north of the Nordic region. If we look at oil markets at this juncture, we've obviously had a spike in prices over the past, say, 6 to 8 weeks, but I think there is more in the making. And it almost seems like we're stuck on repeat relative to 2021, 2022, if we look at the most recent market trends since the middle of the summer here. If we look at this chart on the price action in the US dollar, in interest rates, and in energy this year compared to the exact same period last year, we now have a situation of broadly stronger commodities. That's the BCOM in yellow and red. We have a picture of a stronger US dollar, both in 23 and 22, and we have a picture of higher interest rates in the far end of the yield curve, both this year and last year. This is an odd cocktail, historically speaking, because typically you wouldn't have seen a scenario with a stronger dollar and stronger commodity prices and stronger energy prices at the same time. But I guess this goes to show that correlations have flipped globally. We now have the supply side firmly in the driver's seat of price action in commodity space, which basically means that now that the US is a net exporter of commodities, the dollar stands strong in such a scenario relative to what we've grown accustomed to over the past decade or two. This is an issue mostly for energy importers. To mention a few, the UK, the Eurozone, Japan, all three will suffer big time if these trends continue. And I think there's a decent risk or a decent chance, depending on your position in markets, that oil markets will continue to rally during the fourth quarter. If we look at the supply-demand balance right now in oil markets, I'd argue that we are now clearly in a so-called supply deficit territory. If we look at the demand side, first of all, in dark blue on this chart, the oil demand is now visibly above pre-pandemic peaks. So this whole narrative that the demand for oil would never make a comeback post the pandemic is basically nonsense. And I would argue that the trend is your friend over the next year or two here as well on the oil demand side, maybe even reaching as far as 105 million barrels a day or so, should we look 1 or 2 years ahead. And if we look at the supply side in the lighter blue, we're now below 100 after the decision from the Saudi Arabians and the Russians to prolong production cuts throughout the fourth quarter. And frankly speaking, it will be difficult for the West to counter this supply deficit since we're running relatively low on inventories across the Western world. If we look at what typically happens in physical oil markets when there is such a deficit in the supply, we typically see quite a rally in oil prices subsequently after such a supply deficit relative to demand becomes a reality. And that's why I say that oil prices could rise as much as 25 to 30% during the fourth quarter, which would be a catastrophe for both Western economies, but also Western central banks. What we have on the chart here is the quality change in the oil price in the lighter blue, and then this supply-demand imbalance in oil markets in darker blue. And do note that the right-hand axis is reversed here. So when there is a -2 here, it means that there is a daily undersupply of roughly 2 million barrels of oil throughout the fourth quarter and into year turn in global oil markets. And as you can see, typically on the left-hand scale, we get, I'd say, 20-30% price increases in oil as a consequence of such an undersupply that we haven't seen In many instances over the past couple of decades, we've rather seen the contrary, so an oversupply of oil relative to demand. But that has surely changed now with decisions taken by the Saudi Arabians and the Russians to prolong this supply cut throughout the year. So, can we do anything about this in the West? Well, we know that Joe Biden has used the SPR, the Strategic Petroleum Reserve, to sort of mitigate price pressures from this tight supply side. And should we sort of play with the thought that Joe Biden wants to counter the entire supply deficit for the fourth quarter, then the SPR is going to be more or less depleted by Q1 next year. The dotted line in the chart here on the with the scenario for the SPR inventory relative to this undersupply shows a running release of 2 million barrels a day, essentially what's needed to bring balance back in oil markets. And we would very quickly go from levels just north of 300 million barrels in that inventory to, around 100 come year turn, should Biden release 2 million barrels a day. And my cynical analysis of this is that it is too early for Joe Biden to really counter this trend. We're still a little bit more than a year away from the election date. And I suppose that he wants to save the ammunition until later in 2024 to be able to mitigate price pressures ahead of the election rather than now. That would at least be more optimal from a cynical perspective politically. If we look at the factors driving the crude oil and Brent oil move right now, I'd say that it's basically a broad-based pressure in an upwards direction in the oil price. We have a composite index of the factors sort of driving oil prices in both directions. And as you can see, we've had a positive contribution from the manufacturing PMI. We've had a positive contribution from the dollar leg. We have a positive contribution from flight data, positioning, and inflation expectations, etc. But inflation expectations are still relatively low compared to oil prices right now. That is the red bar below zero in this C-score. So should we get that increase in inflation expectations, which I find likely as a consequence of this, we may enter this doom loop where commodity risks are hedged by risk managers in flight companies, similar types of corporates, in anticipation of high inflation ahead. And then we enter a doom loop where commodities are bought because of the risk of commodities being bought. And I frankly think that we're amidst the sort of early innings of such a phase, if I'm right, that the undersupply of oil will continue throughout the remainder of the year. If we look at energy in a broader sense, I also think that natural gas is worth watching now. I've been bearish on natural gas, and I've been vocal on Real Vision on that view since the early autumn of last year, especially given the price action seen in the European market at the time. But as you can see from my model here, it's a quantitative probability weighted model. We've gone from, say, 15% probability of increasing natural gas prices to now 50%. That's quite the move in a matter of months, and we haven't really seen the price action backing it in spot terms. So this is a very strong forward-looking signal from my model. Should we get to, say, 60-70 in this model, I would surely consider going long natural gas. Both Henry Hub and the TTF indices look historically low, I'd say, relative to the supply situation. To give you a flavor of how tight the supply situation is in Europe, we still get 30 to 32% less natural gas in to Europe on a daily basis compared to the scenario just prior to the invasion of Ukraine. The demand is down 20 to 25%, depending a bit on the temperatures, simply due to the fact that the German industrial sector is not performing, it's not producing, and due to the fact that the temperature season has been very benign over the course of the past 9-12 months in Europe. Should we get a colder winter, and should we get just a sort of a glimpse of optimism in the European industrial complex, then natural gas is surely a buy given the tight supply situation.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
Of course, it poses risks to the inflation outlook. Um, Both in headline and in core terms, I think this oil spike is something to watch because eventually, when you get such a spike in energy prices, there's a risk of spillovers to everything else in the consumer basket. And when we watch the most recent month-on-month trends in both all items, so headline inflation and core, we're running below trends from the pre-pandemic era. But I guess this will change with the release of the inflation report next week, given how big of an impulse we get from the oil market right now. And headline inflation will surely outpace expectations, if you ask me. We also see how now casting models, for example, the Cleveland Fed now point to a very hot month-on-month number for inflation. The latest, last time I checked, it was around zero point 0.7, zero point 0.8 on the month, that increase, out of league with what we've seen over the past couple of quarters. So, what is this a symptom of? I've been highlighting lately that we're about to see a rebound in the manufacturing sector. And I think that rebound is also a part of the demand story for oil. Obviously, when manufacturing is on the up, you demand more oil, you demand more energy in general, also electricity, obviously, and natural gas. And there are signs of a pickup in manufacturing. We've received the ISM manufacturing gauge, was it last Friday, hinting of a sequential improvement, not to the extent that I had hoped for. But if you look at the details in the report, improving orders relative to inventories, I'd argue that it is very likely that we will get to 50 or 55, that range in the ISM manufacturing already before New Year's. And that's sort of a game changer relative to the contraction territory we've been in for manufacturing for a while. And if we look at the impulse stemming from lower input costs in the manufacturing sector over the past year, you could even argue that we would go as high as 55 plus in the ISM manufacturing. So the necessity impulse in this chart is a mixture of chemicals, food, and energy prices. So the input prices in the production of these three major components for necessities. And they've dropped more than 50%, at least until recently. And it typically allows manufacturing to thrive since they can lower input costs. By far, the biggest input cost of the cost base is very sort of resources driven here in that sector. And that will allow them to increase production and at the same time also marginally decrease selling prices, but still increase margins. And that's in sharp contrast to what's ongoing in the service sector. I know that we received a smoking hot print from the service sector yesterday in the US. Um, but my take is essentially that when wages outpace inflation, we've seen that lately. Service companies will struggle since their cost base is, say, in between 60 and 80% based on labor. And the reason why we've had such a strong labor market in the US is that labor costs dropped materially relative to selling prices throughout 21 and 22. And as you can see from the chart here on real wages relative to ISM services, we went as low as -4% on the right-hand axis. So on real wages, we went as low as -4%. That's a massive cheapening of labor relative to selling prices because it's essentially a real wage is the selling price minus the labor cost. And now the tide has turned. We're moving towards, say, 2 to 2.5% labor cost growth in real terms. And as you can see from the chart here, every time we've had a substantial decline in services, it's been preceded by some kind of a pickup in prices of labor in a real perspective. So even though it looks odd to say and sounds odd to say this right now, I think we have a restocking cycle ahead in manufacturing. Inventories will be taken up to ensure that production can sort of remain on track if demand picks up as well. Inventories are very low in manufacturing, while inventories are increasing in services, even though they rarely run big inventories. But still, from a sequential perspective, I think manufacturing will start to, on a momentum basis, outpace services. And that's a game changer relative to what we've seen over the past year or so, where we've had the complete opposite picture. Um, you could also argue that various market trends suggest that either manufacturing and the manufacturing of goods is already rebounding. The chemical sector is typically a prelude for developments in the manufacturing PMI. And we've seen a decent pickup in such sectors over the course of the summer. Energy also worth mentioning here, obviously. So I would remain focused on sectors with the link to that manufacturing cycle, with the link to the commodity cycle, while staying away from sectors with a strong cost base or a large cost base related to labor. On the contrary, we have no signs whatsoever of European activity levels rebounding. But that could, of course, be a sign for the European Central Bank to pause. Uh, and I still consider it much more likely that the European Central Bank will pause interest rate hikes and will eventually move to a cutting cycle than the Federal Reserve, especially given what we've discussed on manufacturing and oil prices. I think there's a scope for headline inflation to maybe reach 4% again in the US, maybe even 4.5% if this oil rally continues. But in Europe, we still have a decline in momentum in inflation. If we look at the various components, services only make up, say, 2 to 2.5% of that inflation basket from a year-over-year perspective, the dark blue bar here. And therefore, the broad-based inflation is not seen to the same extent as in the US, where we have a more sticky inflation picture in services, I think. But obviously, if we get that re-increase in oil prices, it smells a slight bit like stagflation in Europe, doesn't it? To give you an example of why Europe is not performing, well, less energy cannot yield the same output. Goes without saying that energy runs through the veins of right about every corner of the economy, also in industrialized nations such as Germany, Sweden, etc. in Europe. And to give you a few high frequency data points from Germany, the light blue line here is the electricity consumption in Germany, and it's down 15%-ish from peak. Uh, that's out of the ordinary. It's not ordinary to consume less electricity if you're growing. So this is a symptom of an economy not growing. And as you can see, we're sort of stagnating from a momentum perspective in the electricity consumption. The truck toll mileage is now also declining, meaning that goods are not moved from A to B in Germany to the extent that they were a few quarters ago. So the recession is here in Europe, but it's not here in the US. So that discrepancy has only grown even wider since the last time we updated you on Steno signals. So how do we position for this? We can have a look at our portfolio book as the final thing before we move on to the questions. We remain short European currencies. We remain long energy, XLE, ops-ish 7% since we bought it. We remain long the BCD, an ETF tracking the broad commodity index, so the BCOM index. Then we remain long curve steepness. I use the STPU ETF to express that view. I think it goes hand in hand with that cyclical upswing, with that oil price spike, that far-end yields will outpace short-term yields. But we need a bit of a deceleration in services for that view to fully come into fruition. And then we're short consumer staples, a classic typical example of a sector with a high proportion of labor costs relative to the overall basket of costs. So William is asking me what is expected out of the G20 meeting if this sort of oil price spike continues, and is there any sort of scope for coordinated action against it? And my take here is that Joe Biden will not be willing to use the SPR right now, given that the timing is not optimal. And given that there's still a bit more than a year until the election. So he will not decide to fully counter this trend on the supply side seen from Saudi Arabia and Russia. The dark horse here is China, because China is effectively running policy in Moscow and in Russia as well, if you ask me. So they could, of course, be willing to put pressure on Russia to at least try and increase production. But there are at least a few obstacles for Russia in terms of increasing production. First is that they struggle to transport as much oil as they used to due to sanctions. Second thing is that they used a lot of external companies to do maintenance, etc., on oil fields. So they're struggling to get the same amount of output out of the same amount of oil fields. So I think on a structural basis, Russia's output is on the decline here. And therefore, China will struggle to really get anything out of that meeting with Russia. And I frankly don't see the positive supply news around the corner. I think it's likely that Joe Biden will ultimately unleash the remaining portion of the SPR, but he will do so closer to the actual election date. Also get a question on whether uranium could play a part in the portfolio here. And let me just mention that I find it, if not amusing, then at least striking how substantial an excess return you've gotten in various uranium stocks, for example, against stocks in the wind turbine industry over the past year or so. And it's frankly a trend that I buy into. I struggle to find the good expressions of the uranium trade right now, given how much of a rally that we've seen in some of the stocks that I've been tracking. But on a structural basis, yes, I certainly buy the narrative that uranium will have to play a bigger part in solving this electricity puzzle, also in Europe, despite all of the resistance, for example, from German politicians to utilize the nuclear sector to solve this or mitigate this electricity issue. I think I will leave it at that for this week. Remember that this is a window into my thinking and into my portfolio. It's not necessarily similar to your risk profile or your risk horizon, so let me just disclaim that. And ultimately, if you like what you saw, we have an ongoing exclusive offer for the Real Vision community to join the Steno research platform with live access to the portfolio and with live alerts should I invest into uranium stocks or what have you. You can use the code RV40 to gain 40% off your subscription to Steno Research. With those words, thank you very much for watching Steno Signals this week. I'll see you again soon.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.